Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
HIMS and HERS Health. The reset nobody expected. This article was written by Yanis Zormpanos. Summary. Pause. Revenue grew nearly 50% year-over-year in Q3 2025 to approximately $600 million, with ARPU rising and free cash flow reaching $79 million. Gross margin declined to approximately 74% from high 70s levels due to GLP-1 shipping cadence changes, price cuts, and facility expansion inefficiencies. Operating cash flow approached $150 million in the quarter, with over $1 billion in cash and investments supporting reinvestment and buybacks. Weight loss and GLP-1 exposure are meaningful but not dominant, as personalization now drives roughly half of revenue and retention remains strong. At approximately $29.6, HIMS trades around 2.9 times 2025 sales and 2.4 times 2026 sales, reflecting skepticism rather than growth collapse. Investment thesis. HIMS and HERS Health. HIMS is one of the more emotionally traded stocks in consumer health. A 40% drawdown since my last coverage is generally a sign that something is broken. In this case, I see something else. Something that was broken is not the model, but rather a set of expectations that have increasingly moved into fairy tale land. I think the question investors are asking themselves is, has HIMS finally topped out as a growth story? Or is this the hard part, where the platform moves from the growth story to the cash flow story? After reviewing the numbers, the earnings call, and the longer-term guidance provided by the company, I think it's the latter. That does not make this a low-risk setup, but it does make it an investable one under the right framework. Strong numbers, soft margins. Why growth didn't break, expectations did. So let's start with what really happened operationally. HIMS and HERS Health's revenue increased year-over-year by nearly 50% in Q3 of 2025 to just under $600 million. Subscriber growth was still healthy, ARPU increased, and free cash flow was $79 million for the quarter. These are not numbers of a company with a broken business model. These are numbers of a company that's gotten large and is feeling some friction as a result. The tension manifests itself in the margins. Gross margin fell to the 74% level from the high 70s that investors had grown used to seeing. Again, the change was significant rather than subtle, and the stock price reflected that change. However, if I dig deeper into the numbers, the vast majority of the change can be explained rather than being mysterious in nature. For example, the reduced GLP-1 ship cadence, price reductions to increase access, and the less efficient cost structure related to facility expansions all impacted the business at the same time. Again, management did not attempt to gloss over the fact that these were near-term margin pressures that were the cost of verticalization. What is more important to me is that operating cash flows continue to grow substantially. The company generated nearly $150 million in operating cash flows in the quarter, exiting with over $1 billion in cash and investments. The balance sheet is not just strong, it allows us to invest aggressively without having to access the public markets, to weather any volatility that may come our way, and even buy back stock when we see dislocations in the market. I believe that this was the first mistake of the market. It was a mistake to assume that this pressure was not a transitional problem, but a long-term one. It was a mistake to assume that this company was not making a long-term choice to reinvest. GLP-1's the risk, but not entirely the explanation. Much of the fear surrounding HIMS has to do with GLP-1 exposure. But that fear has only grown more potent in recent times with Amazon's AMZN announcement of its plans to charge high prices on the distribution of brand name Wegovy. This appears to be a direct attack on what has arguably become one of HIMS' most rapidly growing segments. Of course, there are risks in play here. Compounded GLP-1 products are in a gray area. Pricing power will not be infinite. Nevertheless, I think that the market is oversimplifying the dependency. Weight loss as a growth driver is a big part of the growth, but it doesn't define the rest of the platform. I think what really jumped out to me from the earnings call, beyond the overall growth, was just how well the company has learned to talk about the business as a life cycle, not a one product, one user kind of thing. Personalization now drives about half of our revenue, retention remains strong, and multi-condition subscribers are now the norm, not the exception. However, more important is what comes next. Diagnostics, hormones, menopause, and longevity are not incremental additions to the service. In each of these spaces, the service model fundamentally changes. In the case of whole-body lab tests and the integration of those tests into the overall plan of care for the patient, the model fundamentally changes from an episodic model to a proactive model. This model change is important for the business for the following reasons. It expands the market opportunity and reduces dependence on any particular therapeutic area. I understand the risks of GLP-1, and I'm not dismissing them at all. What I'm saying is that it's priced as if it's an existential threat, as opposed to it simply being a part of a larger equation in a platform model. Growth is slowing because math always wins. Perhaps the biggest misperception about this sell-off has been related to growth deceleration. Revenue growth slowing down from triple digits to less than 50% has been a cause of alarm. It is impossible for a firm's growth rates to remain at early-stage rates once it reaches a revenue of approximately $2.4 billion. In addition, consensus growth expectations for 2026 are approximately 18% growth. While this feels emotionally disappointing, that is only because the market anchored off unsustainable prior comps. From a business standpoint, high teens growth at scale, along with increasing cash flow, is not a failure. Rather, this is a transition point at which valuation frameworks should change. Management has guided towards a $6.5 billion revenue and $1.3 billion adjusted EBITDA goal for 2030. This represents a compound annual growth rate of about 30%, which is lofty but not ridiculous, especially if the international business and new specialties continue to accelerate. What investors need is not another 50% growth spurt from HIMS, but efficient growth with a widening moat. Valuation in numbers, expensive on EPS, fair on sales. At $29.6, the company appears expensive based on its earnings, but reasonable based on its revenue. As the market is expecting $2.35 billion in revenue for 2025, plus 59% year over year, and $2.76 billion for 2026, plus 18%. The company is trading at 2.9x PS for 2025 and 2.4x sales for 2026. Paying a mid-2x sales multiple for a company with a still high teens growth business isn't extreme. The narrative of overvalued is largely based on EPS. 2025 EPS is 0.48, approximately 62x forward PE, and 2026 E is 0.630, approximately 47x. Risks that actually matter. There are real risks that should be considered in a regulatory situation in a compound drug, which will have a significant bearing on future revenue growth. The competition from Amazon and traditional pharma distributors will test the pricing discipline, but internationalization risks are execution risks, especially in a difficult landscape like Europe, where the business will be significantly different from the US. In addition, there is a softer risk that is difficult to model. As HIMS expands into diagnostics and longevity, there is a shift in marketing from discrete performance-driven marketing to a more brand-based model. This is a disruption in the way customer acquisition costs work. While management seems confident about how they can leverage this in the future, there could be a period of turbulence. Takeaway: HIMS is
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.